we begin with that big newsmaker this hour. Netflix CEO Reed Hastings just taking the stage at the New York Times Dealbook Conference with Andrew Ross Sorkin. Let's listen in.
It's actually back to our stage because you've been with us before, and we thank you now.
I have.
But one of the reasons we wanted to see you was because we are right in the midst of the streaming wars.
We are.
Which have just begun with Apple Plus just last week and with Disney Plus coming next week. And I want to use this opportunity for you to help us understand how you're looking at all of these different component parts and what's about to happen to our media ecosystem. So here's where I want to start the conversation.
Good.
I know that you have historically said that you don't think you have any competition, or that if you do, it is with sleep. You remember that line? It was a great line. Only got a couple laughs here, but you got more laughs before.
When I do it, it's better.
Yeah. Thank you. And so my question is, now that you see what's happening in this ecosystem, an ecosystem which you effectively have created or at least inspired, what you think is going to happen. You look at Disney Plus, you look at HBO Max on one side. You obviously have Hulu still in the middle of this.
Huge, yeah.
Apple. What does it look like to you?
So there's a lot of competitors all throughout the world, but if you're asking in the US market, YouTube, Hulu, Amazon Prime, Netflix, all launched 2007, 2008, so 11 years ago. The four of us have been, competing hard for all this time. And then everyone's realized, wow, this internet thing really works. And consumers are enjoying it. And so now all the major media companies are investing in their own services. And it's great for consumers. There'll be some more competition for us, but we've already got a lot of competition. And most of it is people will watch less linear TV and now watch, say, Disney content on the Disney Plus service.
So do you think, I guess the real question, though, is, do you think that people are going to make decisions and say, I'm going to either do Disney, or I'm going to do Netflix, or I'm going to do HBO Max, or et cetera?
Not in terms of subscribing. People will subscribe to a couple services the way that they subscribe to a couple news services. But then in terms of time, that's the real competition. The tricky thing in this streaming war is, Apple and Disney's not going to break out revenue for the service, and you'll hear some subscriber numbers, but you can just bundle things in, so that's not going to be that relevant. So the real measurement will be time. How do consumers vote with their evenings, and do they end up watching what mix of all the services? So starting in Q1, you'll start to see a breakout of that, like from Nielsen and others.
Bob Iger told our own Maureen Dowd, look, no one will ever have a monopoly or mythology or on storytelling, not us, not anybody. What Netflix is doing is making content to support a platform. We, as in Disney, are making content to tell great stories. It's very different.
Yeah, I would say we're both trying to please consumers. So, our North Star is, how do we do content? We have The Irishman coming up, we have Two Popes, we have The Crown in a couple weeks, and that's about pleasing our customers. And that's what Disney does too. Disney's been doing creative content for 100 years. They're incredibly good at it. They're $80 billion in revenue, we're $20 billion. And we're both focused on, how do we win viewing time from you by doing incredible work, telling stories that you all care about.
But how much of it, and people, the critique about Netflix is that it is a volume play, that you're trying to be TV, all of it. And that some of these other services at least are marketing themselves in a different way. I don't know if you think that they are.
Until they start producing more, and then they'll say, we have variety.
Right.
Okay, because that's what we say now. We have incredible variety. So we have a show, Quicksilver, out of Sweden, crime thriller. Did super well in Sweden. Of course, you expect that or hope for that. But it did 15 times more viewing in the rest of the world cumulatively than it did Sweden. So we've got this huge opportunity there. And then interestingly, and it's huge in Argentina. So you get these, if you produce a wide variety, you get lots of different sharing around the world. And fundamentally, we want to produce everywhere in the world and connect people. Really build empathy through all those shows. And to do that, that takes a wide variety.
How worried are you that this is all one grand bubble? And the reason I ask is, you're spending a small fortune to be doing what you're doing. You're taking on debt to do it. Others are spending enormous amounts of money, often either taking on debt or going to at least take on losses, depending on the corporate structure, for quite some time.
Well, probably the definition of a bubble is it goes down again. And I don't think subscribers or cumulative media spending is going to go down. So linear TV is a huge both revenue source and time source that's declining. And that's fueling the growth of all of the internet services, including YouTube, including video gaming.
You don't think you're going to ultimately have to take down spend?
No, we plan on taking spend up quite a bit. We're growing and investing around the world. We've been strong in series. Now we're getting really strong in movies. We want to big thrust for us, a little bit this year with Klaus is animated. And next year we've got really beginnings of a great animation slate, so we're investing heavily there. Unscripted, we're doing more and more. So, we got a long way to go, especially on a global basis. And that's the thing that I think people underestimate, here in the U.S. is, the U.S. is 5% of the world's people, and 95%, all of those people around the world love entertainment, love television.
But there seems to be a massive land grab for talent, both stars themselves. Obviously, Gwyneth Paltrow has been working with you. We just spoke to her. But also for showrunners, you're paying, certain showrunners $300 million, reportedly, to bring them aboard.
For multiple years, for multiple shows. We're still not doing the very biggest movies, the $500 million kind of movies. So, there's ways to go. In TV, we're
Do you think you will?
Up. I think we'll continue to push the edge in entertainment as we get more distribution. We want to have content and stories that people feel is unusual, something they haven't seen before. So we do a lot that's very economical and tells an amazing story. Others that has incredible special effects.
Pricing question for you. So now that there's all this competition, one of the amazing things about Netflix and so many of these services, and you've long been a pioneer in this, is to say, you can cancel anytime you want.
Sure.
Right? And one of the things that Disney is doing is trying to elongate that. So they're actually, if you want, you can subscribe for a year. I think in some cases you can subscribe to 3 years. Do you see long-term people being able to cancel as quickly as they can? The reason I ask is there's so many people who say, I love, name a series that's on Netflix. I'll binge it, or I'll watch 5 series this month, and then I'll switch it off, and I'll go over to HBO Max, and I'll switch that off 2 months later, and I'll go to the next place.
There's lots of ways over time, different tiering, different times to tune the commercialization. But again, really what we focus on is how do we have a service people want more of the time? So we don't focus on how to lock them in. We focus on how to attract people, how to have, so that, we want you, anytime you want to relax, you're in front of the TV and you think, do I turn on the cable, linear TV? Do I turn on YouTube? Do I turn on Netflix? And we want you to choose Netflix because you're in the middle of a great show, because you're going to find more, because there's great titles. So that's the main focus.
You've also talked a lot about YouTube over time, and also the idea of mobile. And I've heard you make some hints, more and more comments about mobile, meaning people watching on their phone. Jeffrey Katzenberg is launching Quibi next year. Do you think people are going to watch meaningfully, and you probably get some of the data already, watch meaningfully on mobile?
We've been listening in to Netflix CEO Reed Hastings on stage with Andrew Ross Sorkin at the New York Times Deal Book Conference. We'll continue to monitor this, bring you some more news that develops. But in the meantime, let's trade this. And to me, there are a couple of important things. He was commenting on competition in the streaming wars with so many services coming online shortly. And he said, we're not necessarily competing for the subscriptions. Once they have the subscriptions, we're competing for time, which seems like it would be a good thing for Netflix, because it doesn't matter how much a person watches. I mean, it matters, but it matters more that they're paying the monthly fee. And on the other front, Andrew had asked him, is there a point at which you take down spend? And he said, no, we plan to take it up.
I think the bears will say, there's your reason to sell the stock. You've had a big rally off that 250 level. And we actually flagged the 250 level. Remember, it traded down there earlier this year, I think in December, traded back down in September. But you look at the quarter they reported in early October, it wasn't a great quarter. And their guide for the fourth quarter was, in a word, horrendous. I mean, in terms of U.S. ads, it was less than half of what the street was looking for. International was a disappointment as well. The stock bounced off an oversold condition, not unlike, by the way, Roku, which went up 50% from late September. Now you're seeing what it's doing in the aftermarket. So I think Netflix can live in this world. It just lives, to Tim's point that he's been making all along, at a much different valuation.
Well, it's interesting because if you read the review of the last quarter, which we got a couple weeks ago, I think October 16th, 15th, you actually heard that the cash content spend was going to go down, and that the bulls are saying that the free cash flow will essentially, the burn will trough in 2019. Now, what I just heard there doesn't tell me that that's going to happen. It doesn't mean that Netflix hasn't been successful with a model that has been burning away. I just believe with a stock that's trading at 95 times trailing, whatever you want to do in the future, that model for investors is no longer a model I think they're willing to underwrite in the stock. I think the bulls will also say, though, hey, look at the way it held this 265 level. And if you draw a trend line off those lows, it actually needed to hold that, and it held it very well. I would just point out that the correlation to the stock breakdown is totally as we started to truly, we always knew about competition, but we truly saw it begin to come online or articulate a plan, and that obviously came to light when Disney Plus actually gave sub numbers through 2024, whether you believe that or not.
And you never had a value play to pick as an alternative. So if you wanted streaming, the pure play was Netflix. Now you have a value play in Disney and in Apple. So there's other choices. So for the first time, I'm pretty negative in Netflix not holding this level.
I mean, the question, though, is Netflix going to lose subscribers because of a Disney? Or will Disney just take people from linear TV, like Hastings had said? We should note, too, that Hastings just told Andrew that he himself would subscribe to Disney Plus, and he says that he admires them to that point.
Well, I think that I don't fully buy that we compete for time, right? Time and money are both resources that are in short supply, right? So I think that it has to be that they will compete, that they'll compete for money. That has to be. Not every household will be able to have everything. So I think that, so you have this business with growing competitors in the macro sense and a raw material, which is content, that is just getting more and more expensive. So you're putting all those things together, even if they maintain their extraordinary position. Let's say they do, and they have obviously an enormous, enormous head start. Still, I come down ultimately to Tim's point, with the valuation reflects something so far beyond.
But the valuation was never good for you. But now you actually have a choice where you could buy something.
Although it's a little bit the tail wagging the dog. If you buy Apple, how do you know how much Apple TV you're buying in?
Right, but
230,
it was the pure
Disney.
play. But to your point, I don't know if it's about just keeping the viewers. Isn't it about growing? Like for Netflix, for the story to be intact.
It depends on where. In the U.S.,
you need
it's about
the growth. But you need them someplace. You need them someplace.
U.S. whole
international
retain,
here.
international,
right, grow.
But in an environment, so here we're all talking about competition. Karen's talking about an allocation of dollars. At some point, like maybe Disney Plus doesn't continue to price the way they did on their introductory level, but that is so much more attractive on a relative value perspective in terms of the offering. So if you're looking at free cash flow burn, you're looking at U.S. subs, which may be starting to get saturated. We hope for more international, but how does the cash burn go down when content spend goes up? And in fact, they can probably not put those increases through. We got so excited 2 to 3 years ago when they started to pass through, and we said, okay, this is going to make a profitable company in the near term. Can they pass through prices now? I don't think so. And if anything, I see it going in the other direction.
That's exactly the point I was going to make. A couple of years ago, they went from $11 to $4. I forget what the dollars were, but they had a pretty significant increase.
Yeah.
In 25% or so, which nobody really blinked at, but in terms of a move that was pretty significant, I think it's harder for them now, if not impossible for them now in this environment to raise prices. And if they're going to spend money, something's got to give, right?
What I don't like, real quick, Disney at 130 has to hold that level. So talk about the competition there. That one is fading pretty quickly as well, and you're not getting that growth valuation with the Disney. So I'd be careful about that not holding the level.